This is David Rodriguez, quantitative strategist for dailyfx.com, here to talk about market conditions this week and basically what we're looking for in terms of trading strategy for the days ahead. So a lot of what we were talking about last week, and sometimes it just gets repetitive, but it really is as simple as this is the stuff we're watching. Things start moving, the themes stay the same. So most of what we were talking about last week was the big moves in the yen and the fact that the yen was at major support, or resistance I should say, against the dollar, against the euro, as forex market volatility prices had risen significantly. So what does that tell us? In short, it means that not only is the yen moving, but traders are betting on and hedging against some fairly big moves. And these are some of the most sophisticated traders in the world. We're talking about FX options markets. You don't need to know what an options price is to understand that when this price is higher, it means that traders expect bigger moves than otherwise. Well, that's exactly what we're seeing right now. So let's go through some charts so I can better, illustrate my point and talk about exactly how we're looking to trade this. So, actually, let me do a couple of things here. Let me clean up my desktop before I switch over completely. But basically, I'm just going to hop onto dailyfx.com. I literally just published a report that details exactly what we're watching. So give me 1 second, bear with me. I'll close my Pandora station so you don't accidentally hear what I was listening to. So let's go back right here, and actually let me just do one more thing. Exit IM. These are the strategies we're watching this week, and the reasons are simple. Because volatility has jumped. Let's take a look exactly what I'm talking about when I say volatility prices have risen fairly significantly. So this is the report currently on the top headline of dailyfx.com. It says, these are the strategies we're watching as the Japanese yen nears major levels against the dollar, against the euro, and other major counterparts. Forex volatility prices, as shown here, I'm basically measuring volatility across the major currency pairs, and what we're seeing is a big jump, especially in the short term. So 1 week volatility is suddenly near its most expensive on the year, which would be approximately the most expensive it's been in several months, and that in itself is significant. We're seeing big event risk in the week ahead, namely with the U.S. Federal Open Market Committee, or the Federal Reserve, to set interest rates, or actually always been called the interest rate decision, but they're going to talk about monetary policy on Wednesday. Excuse me. And then the Japanese yen in particular sees a Japanese CPI inflation report on Thursday. So you're seeing a big pickup, especially on the short end of the curve. Again, betting on and hedging against big moves. And in the medium to long term, 1 month and 3 month, and if I showed it here, 1 year would have also picked up. We're seeing some fairly significant changes. So if you follow along with me regularly, you know that I take these volatility numbers and I translate them into, obviously this is a fun exercise in isolation. If you want to feel stimulated, you can look at a bunch of volatility prices. But realistically, I do this because I translate it into a number for every particular currency pair. And with that number, I say, okay, volatility is really expensive right now, or volatility is really cheap. And that number that I'm talking about, the regulars will immediately recognize it. This volatility percentile, as you see right here, it tells me, okay, where do volatility prices stand in the euro-US dollar, or any of these currency pairs, in relation to the past 90 calendar days. So that's approximately 3 months or a quarter. 89 is a Fibonacci number. The real truth is, I like the story behind it, but it back and forwards as well. Past performance is not indicative of future results, but for the most part, when this number is really high, our volatility-friendly breakout strategy tends to do better. When it's really low, our mean reversion or slow-moving market volatility numbers, slow-moving market strategy tends to do better. Now, again, past performance is not indicative of future results, but I use this as a general backdrop to really put things into context. And when you consider things like, let me bring up my dollar yen chart that I've been talking about. No, this is not the one. So when you consider that the dollar yen has traded to fresh year-to-date lows, which is basically its lowest since mid-December, and is continuing lower. You're seeing the dollar yen hold this minor downward sloping trend channel, but it is holding that key low at about the 102.90 mark, and it looks like it's setting up for a decent short position here. Meanwhile, actually, let me not change the periodicity of my chart just yet. One thing that I was focusing on like a hawk was the fact that the euro yen is at a potentially pivotal mark right here, because 139 represents major multi-year peak. Let's call it 138.50, 139. It's big support, or it was big resistance back in 09. And markets have a short-term memory, but these are the kind of levels that stick out in your mind as a trader. So this is why I think the euro yen could be on the verge of something really big, and I'm not really one to lend myself to hyperbole, but if 139 gives way, you don't really see much in the way of support for the euro yen. And obviously if the euro yen declines, it means the Japanese yen is appreciating. You don't really see much in the way of support until about 350 points later, which was a major reaction high right here, or actually back here in October. General congestion right around the 135 mark. So that's the kind of move we're talking about here. The dollar yen seems to have started this move, but I think some of the best trades might actually be in the cross rates. And in fact, when you look at these volatility prices, you see that the yen crosses look expensive from a volatility perspective. That means that traders are betting on and hedging against fairly big moves. So realistically, you see that sterling yen, euro yen, even the dollar yen, but to a lesser extent. Again, I think the cross rates are some of the most attractive plays here. You're seeing big moves, fairly likely, and this translates into and represents a fairly big shift in terms of what we've been trading in the past several months. Breakout trading. All of a sudden, we're going from watching pure trends or even ranges in pairs like the Kiwi dollar to potentially major breaks. Now, it's still an if. Again, the dollar yen is already broken to fresh month-to-date or year-to-date lows. It is currently holding below that low, so it looks like a decent sell here, especially as, and I posted a couple of links in this report. DB asks, where is it possible to find this volatility and strategy table of yours? So DB, it's currently on dailyfx.com. You can find the current one right there, or you get rid of everything past Weekly Strategy Outlook, and that link will always take you to the most recent one. So I'll even do you one better, because this is how I remember it. bit.ly.com/strategy outlook is how you find the most recent version of that table and those volatility prices. So again, the big focus right now is the big build in volatility, especially as it relates to the Japanese yen. Other pairs are fairly significant as well. You're seeing big moves in the Swiss franc against the US dollar, for example, the Australian dollar, especially the Canadian dollar, which is at multi-year lows against its US namesake. There's a potential for significant market follow-through here. The key question is, of course, what happens around these key pieces of event risk, namely FOMC. Again, for the Japanese yen, it's going to be that Japanese CPI report due on Thursday night, Friday morning, especially because markets are focused on the central banks for the simple reason that they're the biggest market movers. I mean, the Fed up until December was purchasing $85 billion a month, $85 billion US dollars a month in Treasury securities and mortgage-backed securities, which is not nothing. Which is why everyone's obsessed with the so-called taper, because in December they said we're going from 85 to 75. Well, I wrote on Friday that, if I'm not mistaken, actually I just so I don't misquote myself, it was a really impressive number. Let's go to my report from Friday. A Bloomberg News survey showed that 67 of 71 economists and analysts polled believe that the Fed is going to cut its quantitative easing purchases from 75 to 65 this month. And that coincides with something that one Fed official said, they eye about $10 billion worth of so-called taper a month. Again, it's not nothing. The Fed's quantitative easing purchases have had a substantial effect on financial markets, and definitely on the U.S. dollar itself, when you consider that they're basically printing this money out of thin air. They're adding to their balance sheet at an aggressive pace. 85 billion went to 75 billion. Expectation is that they take it to 65, but there's a lot of uncertainty around it. And the Fed proved to us in December that they're not necessarily going to follow a market consensus forecast, because very few people predicted. I mean, there were some people that predicted the Fed was going to start its taper in December, but again, it's just something where anything can happen, and we're expecting big moves. All else remaining equal, that the taper has been bullish for the dollar, just in the sense that QE is bearish for the dollar. So let's see what happens. If they fail to taper, it could put a big dent in the greenback, and the dollar yen could suffer as well. The correlation between markets there makes things a little bit more confusing, just because the dollar yen is also very correlated to the S&P 500 right now, for example. So if the S&P 500 rallies, what does the dollar yen do as the dollar is falling? That I'm not so clear on. But generally, that dollar yen looks like a solid trade. And obviously, we're not just going to blindly go short or blindly buy the yen. That's not our style. That's not how you trade. We're looking for good setups. I think, for example, right now, the dollar yen looks attractive, especially as it holds below that year-to-date reaction low at about the 102.90, 103 mark. And the Japanese yen looks to trade higher, especially if it breaks those major levels. The sterling yen is another great example. It's not quite as significant as the euro yen because it's gotten away from its multi-year high. The equivalent level on the sterling yen would be 800 points lower if we try and compare apples for apples between sterling and euro. But we're still at potentially pivotal reaction and congestion lows right around here at 168.50, the 169 level. So this is the sterling yen, and these pairs are not unique. Dollar yen is in a very similar boat. 102.90 and 103.75 is the level that my colleague Christian Kerr cites as his short-term pivot. And by pivot, I mean not the pivot lines that you see automatically generate in your chart. I mean, if markets close above here, then our bias changes. Christian's pivot is 103.75. Mine is actually a little bit closer. If we see a daily close above 103 even, I'll reconsider my Japanese yen trading bias, at least in the short run, at least against the US dollar. Because we are potentially pivotal levels, and because the next move many people are betting on and hedging against will be a big one. So take a look at this. It seems like we're a little short on participation today, so it looks like it's going to be a short webinar. But I thank you all very much for following along. Best of luck trading this week. Again, take a full look at the report on dailyfx.com right here. It puts in greater detail, it links to all the reports to which I referenced in this webinar. And just significantly, it talks about, okay, this is a currency pair and this is a strategy we think could be more effective or less effective. And I don't have a crystal ball, clearly, so a lot of this is just experience watching these strategies trade over the years and trying to match it to current market conditions. A lot of it's best guess, but it's my estimation that given the recent moves in volatility, these strategies, particularly the breakout 2 strategy and the more trend following momentum 2 could do well. So again, I thank you all very much. Best of luck trading this week, and I'll talk to you soon.